What's up everybody, Nate here, and we've been talking about the stock market on this channel a lot lately, mainly because it had an abysmal January. And experts have kind of gone back and forth about why the stock market is tanking right now, and the general consensus is that it's because of the Federal Reserve. The market has reacted negatively to what the Federal Reserve has said about raising its benchmark interest rates and pulling a lot of its asset purchasing from the stock market. But here's the thing about that though, this is all just a reaction to what the Fed is going to do. They really haven't done much yet in order to tank the stock market. So what exactly is really going on here? Well, while recently the Federal Reserve has had a pretty big impact on how the stock market has performed, Jay Powell's announcements are not the only thing bringing down the stock market right now. There is a lot more going on here. And basically right now we have an IPO market that is melting and some big tech companies that are exploding. Like in case you missed it, Facebook put out its most recent earnings report and it lost hundreds of billions of dollars. Even the Zucks himself ended up losing $30 billion from his own personal wealth. But don't worry, he's still a multi-billionaire. But the bigger issue is these might not be isolated events. There might be a perfect storm growing on Wall Street right now, which could end up creating a total stock market collapse. So today I want to talk about the IPO market and how it is sinking to near decade lows. In addition, I want to talk about earnings reports and more specifically Facebook's earnings and why that is really important to the stock market right now. But before I get into all of that, if you haven't already, hit, smash, or destroy that thumbs up button below and ring that notification bell too. I appreciate you doing that because it shows me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk stocks. So Facebook released its most recent quarterly earnings report, and let's just say it didn't earn much. In fact, Facebook's loss was even worse than that. It suffered the largest single day drop for a stock, losing $232 billion in a single day. That actually broke Apple's record of $182 billion that it lost in a single day back in September of 2020. In addition, Facebook said that it was going to lose around $10 billion this year due to Apple changing its privacy settings. But why exactly is Facebook or Meta's stock so important to the stock market right now? I mean, why does it matter if one individual stock starts to sink? Well, this all has to do with market share and the actual value of a lot of these companies. You see, these companies have massive market caps, and essentially what a market cap is the total value of the company based on how many shares it actually produced. So to keep it simple, if a company has 1,000,000 shares and each share is worth $1, then it's valued at $1 million. However, some of these big companies on the stock market are definitely valued at way more than just $1 million. I mean, we're talking hundreds of billions of dollars here. For instance, Apple and Microsoft are valued at over $2 trillion. They have a market cap of around 2.3 trillion and 2.6 trillion. Amazon isn't very far behind, as their value is around $1.6 trillion. Pretty much overnight though, Facebook went from a market cap of over 600 billion all the way down to 500 billion. So they lost around $100 to $200 billion in their market cap and value basically in 24 hours. So it's pretty safe to say that Facebook or Meta is one of the largest companies in terms of market cap and value in the world. And when a company like that starts to tank, well then the stock market also goes down because it holds such a massive chunk of the stock market in general. That one company has, like I said, $500 billion behind it. So when it starts to lose billions of dollars, what that means is that the stock price or share price starts to decrease. And when you start to see that happen, like I said, your indices or the market in general is going to come down. Now, I don't really want to just pick on Facebook or Meta here because Facebook isn't really the problem. The problem is these massive companies and their earnings reports. So an earnings report basically shows investors how a company performed during its previous quarters. It's going to show you everything from all of the expenses it took on to its sales and its revenue. And of course, its total profits. All of that is super important to an investor because it guides them on how to invest. So if a company is performing super well, then investors will normally keep that stock. But if a company company starts tanking and sinking because it's losing revenue because it has lack of sales, well, that signals to investors that that company might be going under very soon. Now, one bad earnings report won't make investors completely abandon that stock. However, when companies report their earnings, they also report guidelines for an entire year. Like back in 2020, companies were reporting earnings, but they were basically saying on their guideline reports that they did not expect to make a ton of money that year. That also contributed to stocks dropping during that same time. But if we continue to see really bad earnings reports on the New York Stock Exchange, well, that could eventually mean that the stock market is not healthy and investors are gonna run away. Like I said, these companies are massive. Amazon holds a ton of market share, and so does Microsoft and Apple and all of these big companies. They're all going to report their earnings, and if their earnings are subpar, then we could see even more historic drops. Investors have a ton of money behind these companies because they typically perform well. If they stop performing well, then the stock market is going to go down. And right now, it's kind of hit or miss because not every company and tech giant is releasing bad earnings reports. Like, just because Facebook did doesn't mean the stock market as a whole is going to release bad earnings, at least not yet. In fact, Apple put out its most recent earnings and it blew investors away. It was super positive. Alphabet, the parent company of Google, also put out its earnings and it did super well. Now you gotta remember though, the earnings reports are for the previous quarter and sometimes 2 quarters in the past. What that means is they're reporting numbers from 2021. Numbers from the fall and winter. The fall and winter months in the United States are typically a time when the majority of Americans go out and spend a ton of cash. It's the holidays, so you might see earnings reports that are pretty inflated in January and February 2022. They're gonna look super positive because Americans were spending way more than they probably should have, and inflation was at a 40-year high in December 2021, which basically meant that Americans were paying more for all of the same things, so companies were naturally getting more money. But inflation is getting worse in the United States. At least that's what most experts and economists believe. So if inflation is going to get worse, then that means Americans are naturally going to start spending a lot less money. That means your earnings reports in 2022 might be subpar. In fact, they may be historically low. And if earnings reports go that low, then investors are going to pull their money from the New York Stock Exchange, and we could start seeing them put their money into different assets that hold more value. So that's kind of one half of this stock market storm. Big companies reporting bad earnings, but it's not all about the massive companies on Wall Street. There's also a ton of smaller companies too. Like in 2020 and in 2021, thousands of companies launched as an IPO. Now this is an initial public offering. It's the first time that a new public company is going to be offered to the public for them to buy shares. Before that, a company is private, and the only way that they can get extra cash is through private investors. This way, companies can launch as an IPO and get a ton of money from average investors on Wall Street. They can use that money to grow and to build and do pretty much anything they want with. But just because a company launches as an IPO on Wall Street does not mean that it's going to be successful. I mean, we saw some of the largest IPOs in stock market history over the last few years. And this all comes after these companies basically said they're not going to make a single dime for a very long time. Even still, these IPOs were massive. Like for instance, Rivian launched its IPO in 2021 and it ended up becoming the largest IPO of the past 7 years. Overnight, it went from a value of $0 to well over 100 billion. And it soon became even more valuable than some of the biggest names in the auto market, like Ford. So there is a ton of excitement behind these companies right now because new investors or even veteran investors want to get behind these companies as soon as they launch. They are hoping that these companies are the next Amazon or the next Apple. If you can get in very early and only spend $100 or less per share, and the stock ends up growing to the size of Amazon, over $3,000 a share, well, think of how much money you can end up making. The appreciation on your stock is astronomical. But that is all a huge assumption because there is no guarantee that these companies are going to continue to go up. And a lot of them ended up sinking in 2021. 2021. Like, 2021 was one of the worst performance years for IPOs in over a decade. And now that 2022 is here, the IPO dust has settled. So a lot of these companies are now public on the New York Stock Exchange and are out there in the world. But now that they're public, they need to start producing numbers and they need to start releasing earnings reports. And the problem is these companies are releasing bad earnings. And even though these companies are smaller than some of the big players like Amazon and Apple, there is a lot more of them. So in 2021 alone, there was well over 1,000 IPOs that launched on Wall Street. So their share of the market is in the trillions of dollars as well. But the problem is all of those stocks could start to go down if these companies produce bad earnings. What investors are going to find out is that these companies aren't really making any money, and they're going to start realizing that they might be way overvalued. This could potentially be one of the biggest bubbles that we've seen since the dot-com bubble of 2001. Basically what happened there was the internet was growing larger and the stock market was catching on. So companies started to launch as IPOs, but they didn't really have much actual value. I mean, they didn't really have any products or sales. All they were doing was slapping .com at the end of their company name, and suddenly they were valued at sometimes hundreds of billions of dollars. That ended up sinking the stock market because eventually these companies weren't making any money. Ultimately, they weren't sustainable businesses, so they eventually crashed. Right now, a very similar thing is happening in the stock market. Basically, just say you're a tech startup from Sacramento and you're immediately valued at over $100 billion. Even if you have no real record of sales and no real products. And despite the fact that you've told investors that you don't plan on making any money for several more quarters. Investors don't really care. They still poured billions, if not trillions of dollars into these companies, and now in 2022, the fallout is coming. And the bigger problem is now investors are starting to catch on that these tech startups and IPOs in general are not sustainable investments. They're pulling their money, and this is actually causing a lot of other companies from pausing or delaying their IPOs in general. It's a big risk for companies to launch as an IPO. It takes time, money, and effort to do so. So you want to do it at a time that's going to be lucrative, and 2020 was a huge time for companies to launch as an IPO. Part of the reason for this is because our economy was exploding because of all of the free money and money printing from the United States government and Federal Reserve. The Federal Reserve was pouring hundreds of billions of dollars into companies on the New York Stock Exchange. That led a lot of investors to get risky because they weren't betting with their money. They were betting on Uncle Sam's dime. That money is starting to go away though in 2022. So a lot of these investors who were getting risky and throwing their money in an IPO because it wasn't their cash, well now they're holding their money a little tighter. If the market's not going to be good for a company to launch as an IPO, then they're not going to launch. They're going to wait until it's a good time to do so, which basically means that investors are basically stuck with what's in the market right now. On one hand, you have big companies who could potentially produce some pretty bad earnings reports in 2022. Massive companies losing. And on the other hand, you have some smaller companies that are losing as well because they're just not sustainable. Both of those two things combined could lead to a stock market crash in 2022. And of course, couple that with the Federal Reserve raising interest rates and pulling a lot of its asset purchasing, and that pretty much makes the situation worse. Well, so what does that mean for you and your investments? It basically means that we could see some short-term volatility on the stock market. Investors are not going to make those risky plays anymore, or at least not as many risky plays, so they're going to be putting their money in for the long term. This goes beyond 2022 and further. We're talking decade-long investments here. So that's bad for your hedge funds and your short-term traders and your day traders. But it could create really good situations for long-term investors because a lot of these companies are going to start tanking and they're actually really good investments. There's just a lot going on in our economy and world right now that is going to prevent them from making a lot of money. So chances are they're eventually going to go back up. So investors can purchase these stocks at basically a discount. In addition, this could be very good for the stock market in general because markets, no matter what the market is, but the stock market especially, is going to go through a series of booms and busts over time. You're going to see periods of extreme growth and then periods of epic crashes. When you have periods where there is a lot of growth, investors tend to get super risky because there's just so much money going around at that time. New businesses are popping up that are trying to get a piece of that money pie and are just basically throwing it all out there. But the problem is a lot of these companies and businesses are not good. So then that leads to a stock crash because they just can't survive market conditions forever. When you have a stock crash like that, a lot of those bad businesses and assets are going to go away. They just can't survive. The only companies and businesses that are going to be left are the sustainable ones, the ones that are going to be around for a long time, and investors are going to turn to those, mainly because they're the only ones around. What that means for investors is there's going to be a lot of better companies remaining on the stock market if we do see a crash. We might not actually see a crash in 2022 or beyond because there is still a chance that our economy could improve and that these IPOs and larger companies on the stock market could make pretty positive gains this year. It's not the most likely scenario, but it's definitely possible. And if that happens, then you could see the stock market basically just level out. What I'm saying is there's potential for both scenarios. But what is ultimately going to happen is solely based on how the American consumer is going to shop and spend over the next few quarters. Which means, once again, all eyes are going to be on our economy and the Federal Reserve. But enough about what I think. I want to hear what you think about this issue. Do you think that these IPOs are eventually going to crash in 2022 because they just aren't making any money? Or do you think the IPO market is going to be stronger than ever this year? In addition, how do you think companies in general are going to fare on their earnings reports? Do you think we're going to see all-time high earnings, or do you think earnings reports are going to be historically low in 2022? Whatever your thoughts are, leave a comment below before you go. But that is it for me, everybody. I hope you liked this video, and if you did, be sure to hit that subscribe button below. Be kind out there, and I'll see you all in the next one.